4 times a year, every publicly traded company in America is required by law to tell the world exactly how their business is performing. Revenue, profits, growth, debt, everything. These are called earnings reports. And on the days they are released, stock prices can move 10, 20, sometimes 30% in a single trading session. Most investors have no idea how to read them. They see the headline numbers, have no context for what they mean, and either ignore the report entirely or react emotionally to whatever the stock price does. This is week 7 of the Algorithm Investor. Today we are going to fix that. By the end of this video, you will be able to open any earnings report, identify the numbers that actually matter, and understand what they are telling you about the underlying business. You do not need an accounting degree. You do not need to understand every line of a financial statement. You just need to know where to look and what to look for. Let us start with what an earnings report actually is and where to find one. Every public company posts their earnings report on their investor relations website, usually found by searching the company name followed by investor relations. The report comes in several parts. The earnings press release is the summary, usually 3 to 5 pages covering the headline numbers. The 10-Q is the full quarterly filing with the Securities and Exchange Commission. And the earnings call is a live presentation where management discusses the results and answers analyst questions. For most investors, the earnings press release and the earnings call transcript are the 2 most important documents. The full 10-Q contains more detail, but for initial analysis, the press release gives you almost everything you need. Now let us walk through the 4 numbers that matter most in any earnings report. Number 1, revenue, also called sales, or the top line. This is the total amount of money the company brought in during the quarter from selling its products or services. Revenue tells you how fast the business is growing. A company growing revenue at 20% per year is a fundamentally different investment from one growing at 2% per year. The absolute number matters less than the trend and the growth rate. Always compare revenue to the same quarter from the previous year, not to the previous quarter. Many businesses are seasonal and quarter-to-quarter comparisons can be misleading. Year-over-year is the honest comparison. Number 2, earnings per share, usually abbreviated as EPS. This is the company's profit divided by the number of shares outstanding. It tells you how much profit the company generated for each share you own. EPS is the number that Wall Street analysts focus on most intensely. Before earnings season, analysts publish their estimates of what they expect a company to report. When the actual number comes in above expectations, it is called an earnings beat. Below expectations is a miss. Here's the critical insight most beginner investors miss entirely. It is not about whether the numbers are good. It is about whether they are better or worse than expected. A company can report record profits, the highest earnings in its history, and still see its stock price fall 15% on the day if the result came in below what analysts were expecting. Conversely, a company can report a loss and see its stock price rise 20% because the loss was smaller than feared. The market prices in expectations constantly. Earnings day is when reality meets those expectations. Number 3, guidance. This is management's forecast for the next quarter or the full year. Revenue guidance, EPS guidance, sometimes operating margin guidance. Guidance is often more important than the reported numbers. Investors are always looking forward, not backward. Strong current results paired with weak guidance will send a stock lower. Disappointing current results paired with strong guidance can send a stock higher. Always read the guidance section carefully and pay close attention to the language management uses. Words like headwinds, uncertainty, and challenging environment signal caution. Words like accelerating, strong demand, and pipeline signal confidence. Number 4, free cash flow. This is operating cash flow minus capital expenditures. The actual cash the business generates after paying for the investments it needs to maintain and grow. Free cash flow is harder to manipulate with accounting choices than net income or EPS. A company with growing free cash flow is generating real economic value. A company with strong reported profits but negative free cash flow deserves much closer scrutiny. Professional investors often focus on free cash flow yield. free cash flow per share divided by the stock price, as a more honest measure of value than the price-to-earnings ratio. Now let us talk about where most investors go wrong when reading earnings reports. The first mistake is focusing only on whether the stock went up or down on earnings day. A stock falling after strong earnings can be a buying opportunity if the business fundamentals are intact and the sell-off was driven by short-term expectation management rather than a genuine deterioration. The second mistake is ignoring the earnings call. The press release gives you the numbers. The earnings call gives you the context, the tone, and the forward-looking narrative from the people running the business. Listen for how confidently management answers analyst questions. Do they give specific detailed answers or vague deflections? Are they raising or lowering guidance? Are they buying back shares? A signal they believe the stock is undervalued. Or issuing new shares which dilutes existing shareholders. The third mistake is looking at one quarter in isolation. One strong quarter does not make a business. One weak quarter does not break one. What matters is the trend across 4 to 8 consecutive quarters. Is revenue growth accelerating or decelerating? Is the profit margin expanding or contracting? Is free cash flow growing? These multi-quarter trends tell you far more about the health of a business than any single report. Let us walk through a practical example using a fictional company to bring all of this together. Imagine a technology company reports quarterly revenue of $5 billion, up 18% from the same quarter last year, EPS of $2.40, beating analyst expectations of $2.20 by 9%, free cash flow of $800 million, up 22% year over year, and guidance for next quarter of $5.3 billion in revenue, above the analyst consensus of $5.1 billion. This is a strong earnings report by every measure. Revenue growing at 18%, EPS beating expectations, free cash flow growing faster than revenue, suggesting improving efficiency, and guidance that exceeds expectations. Management is confident in the next quarter. How would you expect the stock to react? Almost certainly positively. The business is growing. It beat expectations. Management is confident. Every signal is pointing in the right direction. Now imagine the same company reports the same $5 billion in revenue, but EPS of $2, missing the $2.20 estimate. Free cash flow flat at $650 million. And guidance of $4.8 billion for next quarter, below the $5.1 billion consensus. Same revenue, but missed EPS, flat free cash flow, and weak guidance. Despite the same top-line number, this report sends a very different signal. Margins are compressing. Management is cautious. The growth story may be slowing. This is why reading earnings reports is about understanding the complete picture, not just one number. Where do you find earnings reports and earnings call transcripts for free? 3 places. The company's own investor relations page. Search the company name followed by investor relations and look for the financials or press releases section. The SEC's EDGAR database at sec.gov. Every public company files their quarterly 10Q and annual 10K reports here. Free and comprehensive. Seeking Alpha and The Motley Fool both publish earnings call transcripts within hours of the call ending. Extremely useful for reading management commentary without listening to the full hour-long call. Here is the practical habit to build from today. Pick one company you own or are interested in and find their most recent earnings report. Read the press release. Look at the 4 numbers we covered. Revenue growth, EPS versus expectations, guidance, and free cash flow. Then read the first 10 minutes of the earnings call transcript. Do this 4 times per year for every company you own. That is all it takes to be a more informed investor than the vast majority of people who own the same stocks. Next week on The Algorithm Investor, Week 8, we are covering recessions, what they are, how to spot the warning signs before they happen, and exactly how to position your portfolio to survive and even benefit from an economic downturn. For the full breakdown on everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Have you ever read an earnings report before? Yes or no? I read every single one. See you next week.